couple of housekeeping things. I'm Andrew Rosen here, for those that don't know me, president of Diversified. And today's meeting will go about half hour long. We'll stop on time at 12:30. If anyone has questions, they can write them in the Q&A and I can get them to Mike, assuming we have time. But we have a jam-packed schedule, so let's hop in. So, all right, Mike Horwath is joining us, our guy behind the scenes who handles our $1 billion+ and is way in tune with the markets. He is our CIO. He's a certified financial analyst as well, CFA, and he is extremely talented. And we love doing these webinars to reach out to our clients to give them some fodder and some education on different topics. Today, I guess, is somewhat timely. Mike, anything interesting happening in the stock market these days?
No. Quiet.
Good. So we'll keep this short and sweet. But on the outside chance that there is, I'll open up to you to start your dog and pony show and teach us, a wise one.
Well, first, thank you. Welcome everybody to the February 2022 webinar. As you know, we rotate these throughout the year, different topics. So this is my lucky chance, one of, I think, maybe two throughout the year that I'll probably do in a webinar format. But as Andrew said, it's timely. So beyond the Russia-Ukraine crisis, which has kind of taken center stage, I think it's pretty safe to say that the Federal Reserve, interest rates, inflation, those topics, which all intertwine together, have really taken center stage of financial news, of market rotation, market volatility, changing of expectations, all those fun things. So I thought it'd be very timely to walk through all of that, and let's make sure that everybody's comfortable with all the different components of that. So why don't we just jump right on in? I thought a good place to start is, what is the Federal Reserve? That naturally it seems simple, but it's actually pretty complicated, right? And their role, though, and how we need to think about their role can be boiled down to a couple basic premises. So the Federal Reserve is the central bank and monetary authority of the United States. There are many of these throughout the world. If you think about the ECB, so the European Central Bank, the Bank of England, the Bank of Japan, those are all major central banks. The US's version of the Federal Reserve was created in 1913. It was created really coming out of several financial crises and panics. The idea was they needed a central figure to really keep stability in the monetary system. So if you think about this financial reserve, what it is made of, it's got a board of governors. So there are 7 governors on the board, along with 12 regional bank heads. So they head the 12 regional banks around the United States. For example, there's one here in Philadelphia, there's one in New York City, obviously, and then 10 others spread around the country. So there's a term you may hear used, FOMC, that's the Federal Open Market Committee, right? That is the committee that meets 8 times a year, and they discuss really monetary policy. So all of their objectives, they go through the data that defines it, right? The data behind everything, and they make decisions on what the current policy should be. Should they raise rates? Should they reduce rates? What about monetary stimulus or contraction? Different things. We'll talk through what all of that means shortly. But the FOMC in that unit is really who makes the decisions. They meet 8 times a year. There was one in January. There'll be another one here on March 15th and 16th. That group is comprised of the 7 governors of the board, along with 12 regional bank heads. Now, the key is only 5 of those bank heads, which rotate over time, have voting authority. So the 7 governors and 5 bank heads, 12 people get to vote coming out of that meeting. So even though you see a lot of these governors or really the heads of banks making comments in the news, not every one of them today has voting authority. But the goal behind the Federal Reserve and the FOMC is to provide a safe and stable monetary system. They're designed to be independent, right? They're not designed to have a partisan belief Now, that doesn't mean that they don't have personal beliefs, right? If you look at the current breakdown of the governors of the board of the Federal Reserve, Jay Powell is the chairman. He's a registered Republican. Lael Brainerd, she's the vice chair. She's a registered Democrat. Doesn't mean that they don't have their own beliefs, but the policies behind what they're doing need to be rooted to really meet the objectives of what the Federal Reserve is and be kind of independent of whoever's in the White House. What do they do, really? And we'll talk in a second what their job is, but they conduct monetary policy, through a couple different tools, right? The two most important tools to know are money supply and short-term interest rates. So the Fed funds rate is really what would be considered the short-term interest rate here in the US. But they also can control money supply. So you'll hear quantitative easing or quantitative tightening. But those things are ways to manipulate the money supply. But short-term interest rates are the most important, most likely, and the one that really has become really the forefront of what we're looking at, and really has been the forefront of what's changing market expectations. So why would they even raise, contract, or lower interest rates? It's something called the dual mandate. So the Federal Reserve, their objective is twofold, right? The dual mandate is stable prices, which is stable inflation, and to maximize sustainable employment. Another way to say that is low unemployment. They want people working. They want people who want to have a job to have the ability to go into the market and to get a job. So there's other goals that they have, other objectives to regulate banks, to help oversee some other short-term financial lending and rates along those lines. But by and large, their dual mandate is to achieve stable prices and to have low unemployment. They can manipulate the market to try to help achieve that. And they use interest rates and money supply to help get there. So if you think about wanting to fight inflation. So those of you, for example, who lived through the 70s, that CDs were paying double-digit interest. At the same time, you were paying double-digit interest on your mortgage. Inflation was rampant. Inflation was a massive problem. Paul Volcker, who was the head of the Federal Reserve at the time, came in and raised rates quite high. It was all in an effort to fight inflation. And going into the 80s, and really since the 80s, inflation has been much more tame. But those of you who lived through the 70s, especially who were active adults in the 70s and remember those times, it was a point in time when, to fight inflation, they had to raise interest rates. But that is why you would manipulate short-term rates or the money supply. And that's what they do. And that's what we're talking about today. So where are we today? I think that's a natural transition. This is a chart. The blue line will describe and chart over the last 20 years the unemployment rate. The red line charts inflation via the CPI, the Consumer Price Index. So those of you who remember, in the middle of the chart, the great financial crisis of 07, 09, inflation picked up. So unemployment picked up. Inflation remained pretty tame, but unemployment picked up quite high, right? It hit about 10%. And since then, unemployment's been on this long trajectory downward. Okay. Unemployment hasn't really been an issue over the last several years. Coming into the pandemic, we were sitting around a 3.4, 3.5% unemployment rate. For perspective, anything under 5 is pretty good. If it's below 4, that's a very strong unemployment rate. We would consider that mostly full employment. What we also noticed over the last 20 years is inflation's been rather tame. As we fast forward to the end of this chart, which describes 2020 to 2022, we see this spike in unemployment. Naturally, in April 2020, pandemic hits, people are out of jobs, unemployment jumps up around 14%. The Federal Reserve, what do? They drop interest rates to really back down to zero. And in an effort to try to stabilize the economy, to try to stimulate the economy, kept it there for 2 years at this point. So unemployment has kind of come back down. Now we sit somewhere around 4%, which is very strong. But as you can see, the red chart, and clearly headlines have described this, inflation has begun to rear its head. So why is inflation now a problem, right? And this is where the conversation turns to the Federal Reserve needs to change their policy. They need to start looking at becoming more restrictive. They've been very accommodative, but now you're sitting here looking at a situation where the labor market's very strong, consumers very strong, but inflation is picking up. So how do we fight it? And why don't we understand why inflation is what it is today? So the first thing I'll say, and what I always like to point out, is this topic requires nuance. We live in a time where nuance isn't allowed in many things. Everybody wants to have, a one-liner and a one-line answer to right or wrong. Inflation today is very nuanced. The reason for that is there are supply side pressures and there's demand side pressures. So let's start supply side. We are in a global pandemic. Everybody knows this. A global pandemic means that every economy has their own way of dealing with it. We've also had to deal with lockdowns. Shipping costs have increased. I was looking recently at the cost per square foot to ship something. Shipping costs have, and we have several clients who work in supply chain. It is a very difficult place to be right now. But that is supply driven. That is driven mostly by this pandemic. Then we have the demand side, right? The demand side is what I think a lot of people think about when they think about inflation. It's too many people chasing too few goods, but it's demand side. The consumer is very healthy. I put out a video in January describing the consumer here in the United States. Very, very healthy. The consumer's balance sheet very strong. Debt debt payments as a relation to disposable income very low. We've also had fiscal stimulus. Everybody knows that the government stepped in 2020, early 2021, provided direct payments to people, provided support to small businesses. We just talked about the Federal Reserve stepping in for monetary policy. As part of that, they dropped interest rates to the ground. Why is that important? Mortgage rates have hit or had hit all-time lows. People refinancing their 30-year mortgage to 2.5, 2.625, and incredibly low figures, right? Debt was really cheap. So what happens when debt's really cheap is that you can spend more money on the asset and pay the same amount on a monthly payment, right? Low interest rates have been very accommodative to markets. And I also think there's an element of e-commerce here, this last line. I don't think companies realized how sticky e-commerce would become. It naturally accelerated through the pandemic, and it's really stuck around. And e-commerce, I think, has made supply very difficult, but has also increased demand quite a bit for a lot of goods and across a lot of different industries. So we have this combination of both supply side pressures and demand side pressures. The challenge is the Fed raising rates doesn't solve everything, right? The Fed raising rates can help on the demand side, but maybe it can't really solve the pandemic problem. There were times when the port of LA had 100 ships queued outside of it, when normally it's somewhere around 15 to 20 ships. The Fed raising rates isn't going to do anything there, right? So that is the natural challenge of what the Fed is going to do and what they have to work around, which is partially why I think the market pricing in a very, very aggressive Federal Reserve may be an overstatement, because the Fed knows this. The Fed knows that them just going very aggressive and raising interest rates doesn't solve the problem, right? It helps to mitigate the problem, but there's also pressures on the other side of this that have to get worked out. So tying in, we have inflationary pressures. What does that mean? This chart is the Fed funds rate since 2000. For much of the last decade, it's been near zero. I don't think that's a surprise to many people. Your bank account has earned virtually nothing for the last decade, but you also were able to borrow at very, very low rates. We saw the Federal Reserve start to raise rates in that 2016 to 2019 range, but coming back into the pandemic, it was dropped back down to the floor. Looking at the chart, looking at the lines, right? The blue line, the dark blue line, represents the Federal Reserve's estimates over the next couple of years for the Fed funds rate, the short-term rates, and the green line represents the market expectation. all I really want you to take away from this is clearly the market is pricing in, and clearly the Federal Reserve has expectations set that interest rates are moving up. So that ties into, why does that even matter? So the raising of interest rates will impact both the economy and investing, right? The key is those two don't always move lockstep. They can be independent of each other a little bit. There's a lot of overlap. Economically, intuitively, what's going to happen is now debt is more expensive as interest rates rise. So as a consumer, I have to either pay more money to buy a house that, if I buy a house at the price that it is today, a year from now at the same price, my monthly payment is going to be higher. Same thing with a car. So debt is now more expensive. Entrepreneurs or small businesses or even corporations to get and raise funds via debt is now going to be more expensive. This can impact consumer spending. Consumer spending, we've always spoken about, is 70% of US GDP. It will have an impact from an economic perspective. Investing, the other point to think about is bonds have an inverse relationship to interest rates. So as interest rates rise, bond prices fall. If you think about why that's the case, for example, if you have a 30-year bond, right? A 30-year bond that's paying, just call it 2%. You are locked into a fixed rate for 30 years. If interest rates rise over the next 5 years, that means rates for bonds that are newly issued are much higher. So the value of what you own has now decreased. So that's the challenge of bonds. And we need to be diversified, and we need to think about ways to position our portfolio to mitigate that risk, and also think forward of, are rates going to rise as much as the markets are pricing in? So that's something to keep in mind. Andrew, do you have something you want to add?
Yeah. So stay on the bond thing for a moment there, Mike. So how does someone such as yourself and managers navigate through the bond market? We know what's happening. We know what's coming. We know bond rates or prices are going to go down as interest rates go up. There's no secret there. So what does someone in your position do to combat that?
Yeah, that's actually the next topic. So
all right,
I don't want to spoil it. I'm
all right.
I'm sorry.
Just anxious.
I don't want to spoil it. But great question though. So that's actually the segue. But I'll just touch on one other thing on equities, and then we'll go tie into that, because I think that's a very, very important point. But the other part of why rising rates matters is that stocks, and Andrew wrote a blog on this, tech stocks are a great example. Stocks, the inherent value of a stock is typically the discount of all future cash flows, which can be represented all future earnings. If you discount them to today, that's the intrinsic value of a stock. Now the expectations can be changed and things like that. Earnings projections can factor in, but that interest rate component, as interest rates move up, you discount at higher rates, the value today is lower. That's why we've seen a reversal in markets where some of these higher growth stocks, tech being one specific sector, has just dropped a little bit more than some of the more mature companies and industries that have higher earnings today, but have less growth in the future. So that's just a dynamic of what's happened and how it can affect the investing market. The key I always tell people is markets are forward-looking. All of this is priced in. So if you're waiting until interest rates start to rise to now protect your portfolio from interest rates rising, it's too late, right? Markets have already priced this stuff in. And we always have to be forward-thinking. So be proactive and be patient. Remember, markets price things in, they can get it wrong, and expectations will always adjust. But we need to think about it. What's going to happen in 6 months, 12 months, a year, 3 years from now? And how do we position our portfolio to adjust for those changing expectations? Going into your question, Andrew, this is a great question. So how do we position our portfolio for really these two things? I don't think they need to be thought about independently, because rising inflation is a big reason why we have rising interest rates. So they're not mutually exclusive. I think one leads to the other, which is the Fed's role is to manage inflation. So even though they can have different components to when they'll benefit, or different assets that we can use to fight them, they're intertwined. The chart on the right, the various columns represent different asset classes. The two to the far right represent different stock styles, growth and value stocks. The left with the 5 or 6 columns represent different types of bond asset classes. Each of the rows represents different times when the Fed raised rates. What you can see is that how these asset classes moved over time. In the very bottom row does an average return over these various interest rate scenarios. You can see that it's a little bit mixed. There's no one playbook that always works, right? It doesn't mean that something is not going to work just because rates are rising. You have to take in the other factors, right? What are corporate earnings? What is the economy doing? Are there any other distressed areas of the market? All of that will tie together. But to answer your question about what are things we can be using and what are things that we have used and currently are using within our portfolios, let's start with rising rates. So for both rising rates and inflation, equities are still very good places to be, or very good place to be. So stocks are a good place to fight both. Historically, and you can see it on the chart on the right for rising rates, we've seen for inflationary periods the same thing. Stocks do a very good job of still performing well over time. We're always focused on the long term of stocks, right? They're volatile in the short term. We see it right now, but we stick long term. But even when we look at periods of rising rates, periods of inflation, stocks have done very well. When it comes to rising rates specifically, I just spoke about how, well, if I own a 30-year bond and it's paying me 2% fixed over time, it's going to run into challenges. Well, what can we do is we can buy something called floating rate debt, which means as rates rise, that our interest rate recalibrates every single time, or on a really a set schedule, so that it rises as rates rise. We can also buy shorter duration bonds, right? So instead of buying a 30-year bond, what you can buy is a 1 to 3 year bond. What that means is after a year to 3 years, now we can take the proceeds of that and we can reinvest it into a time when rates have now risen. What do we give up in return is the 30-year bond today will give us more income and more yield than a 1 to 3 year bond. So you give that up. And if rates don't rise by expectations that are priced in the markets, you will be likely at a disadvantage because of it. So those are some of the things we can do for rising rates. And for inflation, like I said, inflationary times, stocks do well. If you think about why, likely it's mostly because companies and the successful companies can take rising input costs and they can pass them along to the end consumer. So if you can do that, you can charge higher prices and inflation doesn't necessarily matter to you as much. Additionally, within bonds, there's something called TIPS, Treasury Inflation Protected Securities. Those securities, the interest resets and adjusts on inflation. So as inflation expectations rise, you benefit and your interest and your yield increase with that. The last thing would be commodities, right? Commodities are a very volatile asset class, but if you think about times of rising inflation, oil rising, for example, is a great example. If you own commodities, you can help to fight inflation over time. We don't love commodities because I think there's some negative properties that come with it, especially with the volatility that they bring, but it is a way that you can almost have a true inflationary a hedge within your portfolio. So just to wrap this all up, the Federal Reserve, right, they are the central bank of the US. Their objectives, really, the dual mandate's the main thing you need to think about. It's stable prices, so stable inflation and low unemployment. Right now, we're dealing with rising inflation and a very healthy labor market, which means the tool they're going to look to is interest rates and looking at rising or raising interest rates to help combat that. Higher rates, they have an effect on the economy. They have an effect on your portfolio. And we take a very proactive approach, and investors need to take a very proactive approach in how they think about it, right? Because now the market's pricing in 6 to 7 interest rate hikes from the Federal Reserve. That's a lot, right? And the Fed only does 4 or 5. That means that markets will reprice themselves as that happens to drop bond yields to help support some of the bond prices. We think the market got a little ahead of itself, would be my best educated guess today. I think the market's pricing in a Federal Reserve that has to take action, but the Federal Reserve has been very clear and they've been very transparent that they're not just going to raise rates in a very aggressive fashion if the data doesn't support that. So we'll see. The rates are going to go up. I think investors should expect March 16th after their next meeting that they announce interest rates will go up. But always remain proactive. Always think about how markets are pricing in expectations and what could change, right? What do we think that is different and how can we remain diversified? So, Andrew, is there anything you wanted to tie all together?
Yeah, well, since we have 2 minutes, why don't you give us your take on what's going on overseas with Russia and how that plays out in your mind? I mean, no one fully knows, but give us your take.
So, one, I think it's I don't want to sound insensitive because I look at it from the economic and the portfolio perspective, right? I think what's happening is obviously very unfortunate and it's not a good scenario for anybody. From a portfolio perspective and a long-term economic perspective, I don't see how that conflict today and the expectations around it affects the profitability and the growth of the US consumer and corporation. I still think everything that we've been talking about and why the economy is strong as it is remains steadfast, right? I still believe that the Federal Reserve has a bigger impact than that conflict. I think that conflict in Russia and Ukraine will affect Europe, especially because of the reliance on natural gas from Russia. I think there is a scenario where that needs to get figured out. Energy prices have already risen in Europe. It's not a position within our portfolio that we are very overweight. We're actually quite underweight that area. So we don't look at it as something that really will affect us too much. I think the bigger effect is in sentiment in the short term. You're going to see volatility because people are concerned. You're going to see energy prices rise. You're going to see maybe some European volatility. But by and large, our thesis for what the current state of the US economy, the health of the US consumer, the backdrop of equity markets is still there. Nothing really has changed. Most of what we've seen is a reaction to interest rate changes and the Federal Reserve. And we're going to see some pullback just from markets getting a little skittish. But I think by and large, it's not that big of a situation when it comes to our portfolios and our economy.
Great. Well, Mike, as always, very informative. You can see why we trust you implicitly and your team. For those that have questions, feel free to reach out separately, of course, and we'll share this with everyone so you can share with anyone you think would benefit. We'll have another one of these in a month or two on a different topic to be determined, but we appreciate everyone. And thanks for giving us a little bit of your lunch hour. And as always, we are grateful for you. So thank you very much, Mike. Thank you. Now get back to trying to make us some money, would you?
Thanks, Andrew.
All right. Take care, everyone.
Take care.